Today's episode is brought to you by Level 7 NYC. If your firm is spending on marketing without knowing what's actually working, guess what you're paying for? You're paying for guesswork. Level 7's marketing audit identifies exactly where each dollar's going, where the budget's leaking, and most importantly, what to do about it. Level 7 NYC, the official sponsor of all things litigation funding. Ladies and gentlemen, boys and girls, listeners of all ages, welcome to another episode of All Things Litigation Funding, brought to you by Level 7 NYC. We have a terrific guest today. His name is Dai Wai, and he's just known as Dai Wai in the business. Dai, a brief introduction. Tell us who you are, tell us what you do, and we will get into it.
Thanks, Ted. My name is Dai Wai Chin Feman. There's no correct way to pronounce it. I'm the U.S. chapter chair of ILFA, which is the Commercial Funding Industries Trade Association. So most recently, I'm managing director with Parabellum Capital. And I remember when we met back early days, you were with Vannon. We were at a conference. They weren't as glitzy back then as they are now. And
that one was not glitzy. I can promise you that lacked all glitz. I remember that conference room.
Yeah, but it did go down in history because there was apparently a fight that broke out between Tom Girardi and I forget who else it was in the audience.
Oh, well, there you go. That's pretty good. That's very exciting. Well, Dai, thank you for being here. Thank you for jumping on. So really quickly, before we get into your work in the field and what you're doing at ILFA and the other stuff we have today, I kind of ask everybody who comes on about this because I think this is sort of interesting how you kind of jumped into the business. What was the first funding deal you were either involved with or aware of and kind of figured out that, this industry exists and how it works?
I can't remember the deal. I guess I would say Donziger, but this really goes back to over 10 years ago. Lee Drucker from Lake Willans, they were posting on Above the Law about litigation funding.
I remember those. Yeah.
And it was super interesting. It's like when you go to your first litigation funding conference, everything is very eye-opening and illuminating. So I started reading his posts and thinking, these guys do the good part of the cases. They don't have to fight all day long with lawyers. They just kind of focus on the merits and move on. And that was it.
Yeah, interesting. Okay, and then you went on. You did some work, I know, for many years as a investment professional in the business. I know you have the title of half your title there is free agent, but you also are doing something, and I think this is really what is made you as visible as you are in the business. Tell us about what is going on and what you are doing at ILFA. Just give us a couple bars on that.
Yeah, so I'm the ILFA U.S. chapter chair. So we're handling everything domestic. That involves the kind of 3.5 federal bills we've been dealing with this year. We've had action in, I think, over 25 states. And then you've got other kind of state level submissions, like in Pennsylvania on the disclosure rule, bar associations, lots of networking with judges and academics. We're kind of covering the whole field here. We have a number of committees within ILFA that generate content, that cover IP, cover government affairs. And then we're also coordinating and managing a large staff of lobbyists federally and on the state level. So it's a big undertaking. We've got a strong team with a lot of our members stepping up. It wasn't a big change for me to come into the role, just kind of formalized a lot of what I was doing before. And it's busy. I would say it was unprecedented this year. We all felt it. And this was kind of in the aftermath of Tillis, which we all felt, which brought the industry together a lot. And now we're, a lot more organized and ready for what's coming. Interesting.
Okay. So I think, look, from what I see, the easy attack on litigation in general, right? Tort reform in general, and then litigation finance is this idea that it drives costs. But what I think, people miss is, when you look at what something costs, you have to talk about what are sort of the benefits, right? And so, when you're thinking about the kind of cases that litigation funders are involved in, can you give people just like a little bit of a flavor of, the kind of like accountability, the recovery to the Treasury from False Claims Act cases? Like, what is the, what is the upshot of this money?
So I think we heard the costs a lot in the Tillis debate. Obviously, there's all these positive externalities. What I like to say, when I'm on the Hill, which I was yesterday, or otherwise, in legislatures, is, you're coming at this viewing it as a lens of, we're controlled by the foreigners or something like that. There's no evidence of that. But what I can tell you is that I have personally funded cases against hostile sovereigns for stealing American technology. We're the good guys here, and that's our story. And it's true, obviously, all the case studies that you see. And at a minimum, we're doing a lot for companies and their creditors. We are helping recover assets, and that's a huge thing and something that needs to happen. Otherwise, there's no accountability. I would say that, what's underappreciated is the private enforcement mechanism of what we do. So Ted, you're a plaintiff's antitrust lawyer, AAI, the plaintiff's bar. Private enforcement's, it's a huge thing in this country, especially given kind of how our antitrust case origination works versus what happens in Europe with the follow-on cases. And so, that's all needed.
Yeah, and I forget the name of the Supreme Court case, but the Sherman Act was to create private attorneys general, and that's why there's treble damages, and that's why there's fees, because not every antitrust violation can be policed by the state AGs, or not everything can be policed by DOJ and FTC. And I think about competition cases because what you always come back to is, like, in antitrust, which is obviously a big part of funding, right? Like, the antitrust laws protect competition, not competitors. Why do people enter into a price fixing cartel? Because it is profitable. What is something that takes away that profit motive? Private antitrust litigation, which, of course, as is where a material amount of the money in our industry has supported, just given the massive costs to bring them in those cases.
Yeah, very cost intensive. Definitely need our capital. I mean, there's a division kind of how capital is provided for these cases. You have self-funding, you have debt finance, right? These are big lines. You have third-party capital. I think we're there to make sure lawyers have options to finance these cases, to make sure the meritorious ones go through. Again, we're the good guys here. I am Chinese, but Trump went to China last week. It looks like everything's cool. So the foreign influence narrative hopefully is...
Well, Putin went there this week, but anyway, I digress. Okay. All right. So let's do one more litigation, because I'm just going to go for the battle of stats. So I read something last week that these guys claim that litigation funding costs $54 billion a year to consumers. I also read that the opioid litigation cost in the trillions. We know that litigation funding was used. Obviously, it was a big part of stemming that time. So can we safely say that if you look at it that way, the benefit, far outweighs the cost? Because that's what all this comes down to, right? Like, cost benefit, at least in some level.
It's kind of like saying, oh, well, like, that environmental cleanup was really expensive for the community. I mean, the cost is driven by the wrongdoer, by the bad actor here.
We should outlaw truck repairs because it's really expensive for the trucking industry. And it's like, that's true, but if the truck's repaired, maybe we can have an industry. Okay. Now let's do, okay. So we've had our shtick. It was very good. It was just how we practiced it. Great job. Okay. So now that we've gotten that out of the way, there's been a lot of talk about different ways to structure both the form of the firm and then the sort of the capitalization of the firm. And there's sort of two buzzwords. We have the ABS, the alternative business structure, and we have the MSO, the master service organization. So I guess, I would just throw it out to you. What are sort of ILFA's thoughts on this? Where's the discussion going? I'm kind of interested.
So the discussion has so far come up in 3 state-specific contexts, which are California, Illinois, and Colorado. In all 3 of those states, the trial lawyers are pushing the bill. and they're
Pushing. When you say pushing the bill, they're against it. They're for it.
The trial lawyers are the sponsors of the bill. So trial lawyers have a trial lawyers association in every state, and nationally there's an organization called AAJ, the American Association for Justice. And in 3 states so far, the state trial lawyer associations have sponsored legislation that would limit fee sharing with ABSs or MSOs, or even prohibit them from operating in certain cases in Colorado. So far, we've been in a position where, fully opposing the bill is largely futile given the trajectory of those bills in the states where they are and the strength of the sponsors. Our focus has been on making sure the language of the bill is not so broad that it inadvertently clips law firm portfolio funding. And so we've been working with the trial lawyers in those states. In Colorado, most recently, there's a carve out that we obtained for portfolio funding. You can look at it in the Colorado bill, which I believe has been signed into law. So we've been working to compromise in those areas, but we're expecting a number more states to pop up. There's another trade association called ILFA, which represents the ABS community. They've been active, and I believe there's another trade association that'll be forming soon as well.
All right. So that's kind of, so let me unpack, because that's kind of interesting. So normally the organized opposition to funding and things around funding come from, big companies that don't like losing their asymmetric advantage in litigation, and insurance companies who have the same issues. They want to settle your traumatic brain injury for $1,100. And you think, no, I'm going to need lifetime care. And they're like annoyed that you can litigate it, and then they lose. And then they say that the lawyers use reptile lizard brain tactics, when in fact they should have just, paid you the policy limits. So, but here you have trial lawyers against this form of funding. So what do you think is kind of, what do you see the thought behind that, and where that's going to shake out?
I think it's like a preservation of moat largely. And I think there's a lot of buzz about private equity and other Wall Street capital entering the legal market, which is previously untapped. And with these new structures and newish structures, or ideas of applying these structures, they think there's access to what's probably an inefficient market in a lot of ways, because there hasn't been professional non-lawyer management of these organizations. I think you're seeing this mostly on the injury and tort side, where there are examples of private equity capital going into one of these organizations with the intent of acquiring other law practices, many of which are in the referral game only. And really their value is, you can think of it a lot like trademark value or trade name value, given how a lot of these law firms originate clients, and that's where the value is. So I think that's what's going on. You have an unlikely alliance, at least in Colorado, we saw between the trial lawyers and the Colorado Chamber of Commerce, just like kind of how litigation funding access to justice historically you'd think of as more democratically aligned, now has bipartisan support from the conservatives as well.
Right. And I guess that, the way I've always sort of thought about it, and I keep waiting to hear it, and I haven't seen it yet, but are you aware of any examples where a client's legal rights were harmed, or they weren't sufficiently vindicated because of the capital structure of the law firm?
I guess I'm aware of the Dentons versus Revolets case, but apart from that, no.
I don't know. Right. So, because the way I kind of think about this stuff is law firm success is largely driven by doing high caliber work and driving the best result. And by the best result, I mean, not every case will win, right? There's a winner and a loser, but there is the best result. And I haven't seen, now in fairness, the MSO model, there's not that many of them. The ABS model has only been around for a couple of years, but I keep waiting for someone to show me the horror stories of, oh, that private equity firm said, don't file that motion, right? Or that private equity firm, only did this. I sort of don't see it going that way. And, I think what we're all going to have to face is the reason you would have an MSO, or the reason you would have an ABS structure, is because the people who own and operate the law firm, they find that to be a superior level of financing than self-financing or recourse bank debt or traditional litigation funding. What do you think about that?
I think it's important to preserve, especially because, as we saw with the Tillis tax, there are things that can come that are unanticipated angles. And to the extent flexibility is needed to continue our business, because remember, litigation funders are managers. We have LPs, many of whom hold interest in funds that are in harvest periods that are mature. We need to protect those. And if there need to be pivots in investment or harvest periods, I think it's beneficial for the industry to have the ability to do that. The issue, though, is that I think there's kind of the perception amongst the trial lawyers that ABS MSO, this is all a way to either actually, in the case of ABS or in the case of MSO, synthetically obtain equity in a law practice when really that's not allowed. And they see that as just a straight up 5-4 violation. And so there's going to be a division between those types of MSOs that are set up for true efficiencies and volume practices versus those that are set up, as corporate structuring. The thing about the legislation that gets put forth so far in these states is each first draft is broad enough to hit both. It needs to go through a negotiation process. But generally, there's going to be a lot more favor amongst the proponents of the legislation for the, true MSO economies of scale versus, the MSO that's there, to synthetically replicate an equity interest.
All right. So let's talk a little bit more. So, I know that in your prior life, before your free agency, you were spending a good deal of your time on commercial disputes, business to business disputes. I don't get the sense that you all were doing a lot of, mass tort cases or weren't doing a lot of personal injury cases. But I think what's lost on people is, to get paid in your mass tort case after the 8 or 10 years of litigation, you need to provide detailed medical records. And in fact, if it's a medical device, you might need to produce an X-ray that shows the SKU number because of the 8 different versions of the device. The settlement only covers 4. And that is wildly capital intensive, but that is not work that is done by lawyers. So I think that when you unpack the idea of outside capital coming into those kind of law firms, it kind of makes sense because a lot of the work that derives the value, and the value is proving up the case, is not billable hour, legal work that needs to be done by a lawyer. It's really more, frankly, investigative and documenting things.
The issue is that if you're a law firm in that situation, you could be presented with 2 types of MSO structures. One is economies of scale, spin it out, get it off the balance sheet, but overall save money. The other is use it as a way, as an infusion of capital, where the return is something where the payment would be far above market for what it is, but it enables the injection of capital. So I think those are the 2 models that, at least in the eyes of the proponents, they're kind of faced with before them.
But the thing that will kill the ABS or kill the MSO is if they're poorly managed and they don't get the legal results and they won't have the client, right? I think ultimately that is, law firms survive based on providing the best outcome. Okay.
The story you're talking about that hasn't happened, though, I mean, it hasn't, right? They're worried it's going to happen. And once someone's worried about that, it's hard to get the ideas out. They want the idea out of that. They want to prevent it. Everyone's aware of the rules of professional conduct, and that's something paramount for these folks. But yeah, I think it's interesting. It's going to be a lot more of what's happening and what we do and what we talk about. And obviously it's going to affect the capital markets on the MSO, given where some of these firms are located.
Okay. So because this is a buzzy podcast and we're right on the pulse, you've heard of AI?
I have.
Okay. So in your view, I mean, what do you think this does to big law over the next 3 or 4 years as to how matters are staffed and how, first level work is done?
I think the big law model, we've been saying it's under pressure for a long time, but that hasn't been borne out in the PPP. They're doing very well. I think it's foolish to think that the cost of legal services is going to go down.
I agree with that. It'll be it's not going down.
It's not going down. In terms of staffing, I'm not sure. And I think that part of that is in clients' hands is how do they direct the staffing and make sure the clients are being efficient using AI. And I'm a law firm today, as you can probably see. Some of the lawyers here are not using AI, some are enthusiasts. But it hasn't fully caught on yet. There's still a lot of stigma. We'll get past that pretty quickly. I think you're going to get into, as AI becomes more competitive and there's more throttling, it's going to be a lot more costs to pass on to clients. And you're going to be back to Westlaw, Lexis kind of phase one and pass-ons. And that's going to be interesting about how those costs are borne. Then, of course, with AI-enabled discovery, if you speak to an expert firm, right? I speak to a econometrician 2 weeks ago, and I said, is this going to bring down the costs of expert work in antitrust cases? Because that's obviously a tremendous line item, at least with the data cleaning or whatever else.
The data. I mean, it's unbelievable the spend on this stuff. It's unbelievable.
Yeah, it's typically like 60 to 100% of the fee budget is costs, and they're a lot less negotiable. But the expert firms are built a lot like law firms, so you're going to see issues there. But then with AI enhanced discovery, the answer to this econometrician was, well, we're going to have a lot more discovery disputes. A lot more in-depth analysis of a lot of things, and it's just all going to get a lot more expensive. On the other hand, will it be more efficient? Will there be more tools to enable defendants to more, rationally settle cases? Will the judiciary and the arbitrators really adopt it to speed things up? Because that's ultimately going to affect the tenor of investments, which is a huge issue for the asset class.
What I think you hit on something there. It's sort of a sneaky point, but I think it sort of makes sense. Is if you are a defendant in one of these mega cases, and let's face it, there are injuries that you caused, right? I'm not saying that every claim and not every claimant will bear out, but one of the use cases, and there's a company in the space that sort of says this, we help defendants figure out what their exposure is in these cases, which I think is very which I sort of think is very interesting. But I think that
there's a whole defendant liability transfer industry out there, and that was at the heart of the DQ motion in Talc with Beasley Allen. Right. Part of the story was how the information was allegedly on both sides.
Right. Where I think AI is really going to put pressure on law firms is, I think the in-house look. It was funny you were talking about how interesting you thought it was, Lake Willens talking about funding, where it's like you do the high level stuff and don't have to do the stupid fight. And as most people who litigate, and I litigated for, 10, 12 years, whatever it was, so much of the motion practice does not affect the outcome of the case, right? So in other words, how many times have you said we object to interrogatory 25 because interrogatory 16 was 3 subparts and blah, 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 and all that kind of BS. And I get the sense that for those motions that really don't matter, I think in-house people are happy to have Claude barf up something and then maybe send it to lawyers. You would hope they site check it. It's hilarious when you read these things about AI hallucinations, as if a junior associate never hallucinated anything either. But I think that's where there's going to be a lot of pressure, is on the non-dispositive work. I think people are just happy for AI to just be like, hey, write broad, stupid objections and responses, and Claude will spit that out in 30 seconds or whatever your tool is. Right. You know me, I like Grok. My guy Grok.
You could spend $50,000 preparing for the depot, or we'll give you this AI earpiece during the depot that will guide you.
Allegedly. Is that another podcast?
It's another podcast. Another podcast I can tell you about the legal tech product I've vibed.
I had one where the case fell on whether this person had knowledge of something, and it took us 2 years to get his depo, and he goes, never heard of it, don't know what you're talking about, blah, blah, blah. And then the errata sheet came back 30 days later, said, change no to yes. Change no to yes. So it happens. All right.
I just want to touch on one more thing, because I get the sense your podcast here, you like to say the points that are supportive of our fine industry here. This is a point that I don't think it's made enough about costs. Mm-hmm. So there used to be a more prominent attack on our industry that we encourage or enable frivolous litigation. Basically, comparing us to patent trolls, which doesn't work for any number of reasons. That's a whole podcast kind of on its own, right? But the notion of frivolous litigation on the plaintiff side needs to be met with the notion of frivolous defense on the defense side. So
wait, hang on. You're telling me the motion to reconsider, the motion for reconsideration was just totally merits based? It wasn't to like mandamusing discovery disputes in state court? You're just saying that was just good old fashioned American litigation? Yeah, it's a joke. It's a total joke.
We've crossed paths a number of times over the past 8 or so years in the industry, and you've seen you're aware of a fair amount of the deals that I've done, and you've seen kind of nothing, you don't get a real settlement offer until you've won at trial often. And so
literally.
And
why would you?
Why would you? The cases are maybe, so big to some of us, but to the big defendant, the Fortune 100 company, it doesn't matter. And they try it as a matter of course. Obviously, certain defendants have that reputation in the patent space. Maybe they're not wrong given the Fed Circuit, who knows? But on the commercial side, when you have an insurance company involved, that's when there's duties of good faith at play. And that's where a settlement is more likely. There's a misconception that we fund insurance-backed litigation. In the commercial side, it's indeed a rarity. And defendants behave very differently in those circumstances. And I think it's kind of one of those worlds where actually if we had control of litigation, which everyone doesn't want, but if we did, things would settle very quickly, very rationally. Just like if insurance companies were actually on the defense of this stuff, which they're not, but if they were, again, it would reduce it. So
you mean in commercial, right? They're not, right. In like in a big antitrust litigation, you don't have criminal price fixing coverage, right?
It's very rare and limited if you have. Yeah. And then there's limited insurance for intellectual property and other intentional acts you're not going to get it.
Well, the whole thing is like, if you're the defendant, every case is frivolous. I mean, that's just like it's like a totally meaningless. It's just a totally meaningless thing to make up. And look, litigation is wholly unpleasant, right? For most small businesses, they're going to be involved in 0 or 1 litigations. But, when something important happens, and you think of it this way, like you gotta kind of pick, right? So either litigation has these eye-popping returns or the cases are all frivolous. But if they're all frivolous, how could they deliver returns, right? It just sort of doesn't logically make sense. Although I guess attacks that are political don't have to make logical sense.
It depends. It depends how much you get into offsets. So just to get back to what you're talking about earlier with we're talking about private enforcement, antitrust. Right. There's the False Claims Act, right? Fraud, waste, and abuse. We'll see what happens at the Supreme Court, but it's another area. We're generating tons of money, and not to mention if Charles Agee reports that $2 billion are going out the door each year to American law firms or American nexus disputes, that's all fully taxed as well. So there's definitely offsets to think about. But that's where rationality comes in. You want to talk about class actions really quick? I know we're running out of time.
I guess you're running out of time. I have nothing else to do today, but there you go. Okay. There's this really smart guy who has an idea for funding class actions. Obviously, I know there's a proposal now about class actions, but like, let's get real. Like somebody, anybody can do it. Google, the last 5 or 10 big class action settlements and how much was spent on out-of-pocket costs for the experts. Because just so people know who aren't lawyers, while a lawyer can be on a contingent fee and the class action lawyers are contingent, an expert cannot have a contingent interest in a case because an expert is there to guide the court. And so those costs sort of add up. And so, Dai,
they're either borrowed or they're paid for with after-tax dollars.
Oh yeah, exactly. Yeah, I mean the lawyers are either self-funding it, they're borrowing it from a bank, or they're doing it out of pocket. Exactly. So Dai, you had sent this thing over, which I think is really interesting. Is it's like, hey, let's just like be realistic, and let's talk about how are we going to fund these things? Because one of the things, the Rule 23 has adequacy of counsel, and so you had some ideas about kind of, let's just get all this out on the table. And so just give me a little bit, some sort of like the high notes on what you think might really work going forward, given the fact that, someone's got to fund these things. So give me some of your sort of high level thoughts on that.
I think big picture, if we look kind of at the next couple of years. So you asked me earlier about what ILFA is doing. There's two big initiatives that I've had kind of in addition to the blocking and tackling and opposing legislation. The first one was the data initiative. So this was a project that started after Tillis, where the ILFA team went and identified approximately 600 cases that we could find touching litigation funding in any way. We human coded them across about 12 fields. We had it AI verified, summarized. This data can be crunched, sliced, and diced. And so this summer, ILFA will be putting out a paper in connection with the University of Missouri, Kansas City Law Review, which goes into that data and shows basically that empirically, the disclosure rule that's sought at the federal level doesn't exist anywhere. To the extent there's a patchwork of decisions, it's because there's a patchwork of different facts and different cases of different types with different laws that apply. But the main principle holds, which is that no one gets a copy of the funding agreement unless there's a special factor warranting its relevance. Right. So that's the data project. Tremendous undertaking. It's now been complete for a few months. It's updated. That's something we're going to be working with a lot to break the logjam with the advisory committee and just make sure they have all the data they need because, again, we're the good guys here, open book. Next thing, phase, I don't know what inning you think we're in of our industry or what game we're playing, but next phase. So we started out single case, kind of morphed to portfolio. Then it was like, how does the industry scale? And so one way to scale easily dollars-wise is corporate monetizations. That requires kind of advanced MDLs with lots of opt-outs for that to happen, which is cyclical. And as you've seen, kind of slowing down, at least with the exception of healthcare, perhaps.
And it's also wholly economically rational, right? You were overcharged for 14 years. The MDL is in year 16. Then you opt out and it's 20 years. And you're maybe you're a distressed restaurant chain, right? Who bought proteins, or you're a health system that, was overcharged in one of these many things going on. And it's like, do you want the chance at $11 million in year 9, or if someone will forward you X dollars today, for these well-worn claims? I mean, it all makes, look, there's this misconception as if like our industry foists this upon people. Why would a restaurant chain monetize its claim in the tuna price fixing litigation? Because it is economically superior than sitting around and waiting for it to see if they'll go bankrupt. That's right. That's the answer. That is the answer.
It's great. However, in order for that money to be meaningful to real restaurant chains with claims, often the check size has to be out of the range of a lot of litigation funders, or they can maybe take one or two and then they've got to concentrate.
And then they're done. Right.
And so scaling of corporate monetization is good, but requires a number of factors. There's also the counterparty risk issue. So you saw what Cisco did to Burford. You've seen other instances of counterparties who are not playing nice and create issues after they've received the funding. And that's an issue in every case that's funded with a real life client. Every single case, and even portfolios have some counterparty risk with the
Wait. You say that people call you up and ask for a discount. If you say no, they maybe don't pay timely. You're saying that happens? Oh my gosh. Wait a second. Maybe we're breaking new ground.
Double encumber the proceeds, various other things that they can do. But counterparty risk is a real thing. And to talk about your counterclaim point earlier, I've been involved in a case where, it resulted in a walkaway settlement at trial, even with an apology, because the plaintiff was just, they had a huge potential payday, but they couldn't live with the potential of a counterclaim, no matter how frivolous it was. And the case got dropped mid-trial.
By the way, that one stings you, man. You told me about that one a while. That one hurt, huh?
I guess it did.
It totally did. That's okay. All right.
Counterparty risk.
I've been there, dude. I've been there.
One of the most underappreciated forms of risk in the
the counterparty is we tell, it's so funny. Like we'll sometimes get on with a really like a top law firm, and sometimes at the end they'll get sort of like the senior people on the investment committee on a call, and they'll start asking questions that are so elementary and basic. And, our clients will do it and they'll say, what do you think that was for? And I go, that was for them testing you. Like, if you've been in a case for 3 years and the judge hasn't read anything, are you just going to have like a pleasant misdemeanor? Or are you going to be like, you're wasting my time? So the counterparty is huge. And the underwriting of the counterparty, because look, underwriting the claim and the facts and the law, anyone can look up what the law is. They can look at the limited information you can have, a draft complaint, the counsel. But, do we think that they're going to act rationally? Do we think they're going to bait and switch us? Do they, do we think that, for example, if a rational resolution came up early, that they would consider it, or are they just going to be wild and off the handle? And that is a huge thing.
We've had change in control. We've had death of counterparty. We've had, in my former life, prior to the agency.
Yes.
All of these things, they can all happen.
Right.
Why am I telling you about this? Because where it happens a lot less is in the class action space. These are largely lawyer driven. Funders have exposure to class action, significant exposure, but typically only through law firm portfolios. And I'm disregarding the credit business for now. So we're just going to talk about commercial funders, law firm portfolio business. You only get access, though, typically to the most intensive class actions, and there's a significant adverse selection issue. So we have here is a market of class actions, which is enormous, which is penetrated very lightly by litigation funding to date in the grand scheme of things. And in many types of cases, there's no funding at all. There's a lot of scrutiny or suspicion that there's litigation funding in class actions that's undisclosed. We've had instances come up in the Gilbert case, for example. We have the Northern District of California standing order and the revised rule there. We also have, you've seen the beauty contest, a big case, and there's contested lead, and the judge says, disclose all these things, give us your firm CV, and do you intend to use litigation funding? It's like a dirty answer if you say yes, at least that's how it's perceived.
Yeah, which is sort of wild. It's like, yeah, we have the money to pay the experts to win the case on behalf of this class at our risk.
Right.
It's like, it throws it on its head. Like, yes, we are willing to lever our return in order to deliver, by the way, a settlement that you, Your Honor, will literally have to sign off on as being in the best interest of this class.
Well, so right? Right. So I'm going to layer on one thing and then I'll kind of come back. The other thing is disclosure. Listeners of your podcast are well aware of the issue. And the disclosure issue, is there a funder there, especially in a class action? If this is something that we could have the court know about in a non-prejudicial way, that would be great. Big picture, our industry exists on a number of different continents, and pretty much everywhere else, including in Canada, our neighbors to the north, litigation funding is, I would say, over 80% directed at class and other collective actions. And that's the commercial funders, not the credit business, right? So that's what everyone's doing elsewhere. We're not doing it here. What's the issue? The issue is we have no mechanism to approve a class action funding agreement.
Not yet. Not yet. We don't. Yeah. Hang on. Here we go.
Well, here we're creating one. So the goal here is to create a mechanism where I think the court has the ability to do this on its own anyways when approving counsel, but we'll propose a rule change to make it crystal clear, but also specify it's within the court's inherent authority, but a mechanism to approve a litigation funding agreement, thereby binding the class to the agreement, just like the class is bound to be represented by the interim lead counsel. And so without that, obviously no funder is ever going to enter into an agreement with a class rep where the agreement may not be enforceable. Brian Fitzpatrick wrote an interesting short piece, if anyone wants to read it, on an unjust enrichment theory here, but it would probably be, unwise to take that risk with an unenforceable agreement. And so we need the mechanism. We don't have it. Right now we have insertions to the market through cost-intensive class actions and portfolios. We have adverse selection issues. Top of that, a lot of law firms, especially on the class side, don't like portfolios, don't like cross-collateralizing things. Meanwhile, funders are chomping at the bit to get at the good risk and also to get involved in things that have less counterparty risk, because ultimately that affects returns and affects pricing. So what we're looking to devise here in a paper also for UMKC this summer is a mechanism to do this. So at the time that there is the beauty contest and appointment of lead, the court would appoint lead counsel and also have the ability to approve a litigation funding agreement for the class. That agreement would make sure under court oversight that it has all of the right language about lack of control. The court would have oversight over the funding relationship to the extent there's any issues, or could appoint a special master or something like that. The defendant would know that there's funding, know that the court has oversight, and that everyone's playing ball. At the end of the day, there would be a formula that's approved in the funding agreement by which the common benefit proceeds that are awarded are divided amongst the attorneys and the funder, depending on the risk share. That way, there's no net increase in cost to the class.
Right. They're getting, if a super fund case gets 25 points,
gets 25
that's how they're
points.
chopping up the 25 points. Yep.
Right. And it gets hacked up. The pie's also likely going to be bigger. And I'm going to get to, now I'll get to the beauty contest. If you're in a situation for a cost intensive case, and the question is, lead slate A, no funding. Here's our firm resumes. We fund all this stuff all the time. B, another slate of firms, we have this funding agreement. Now, it's one thing to say in a vacuum when everyone else is saying it, our firm has been doing class actions for 60 years. We have the wherewithal to self-fund. We don't need litigation funding. It's another thing when a litigation funded backed slate shows up and says, yes, but here's our budget, judge, and we're willing to invest this much through MTD, this much through class cert, this much through SJ. These are hard numbers. You should go to the other slate and ask for the executive committee approval to match or exceed these numbers, because these numbers, early investment, are what's going to benefit the class. And so if you're,
well, and I guess also, do we also want, because look, do we also want a wider array of counsel, especially, and look, and in some of these cases, the work, like, and I don't want to name any particular cases, but like, uncovering an antitrust conspiracy, absent it being like Tuna, where they just gave the emails to DOJ or FTC in the merger review, but like, the workup of these things is incredibly time intensive and sweat equity and money for experts and stuff like that. And then it's like, yeah, but we can't self-fund it, so we can't do it, right? Like that's sort of like, that kind of doesn't like, that sort of doesn't like jive with like fairness. You know what I mean? Like, well, you can't afford it, too bad, get out of here.
That's right. Funding helps level that playing field. Now, however, like, good luck getting a lot of funding prior to being appointed lead, right? In order for that incubation or development. But you can do that through portfolios.
Yeah, but it's sitting there if needed. I mean, I think that would sort of be the idea. Yeah.
That's right. And it's kind of like we create a hybrid model between Canada or Ontario with the public funder, and then kind of the best of both worlds from Europe and UK, acknowledging that we have more flexibility here in the contingent fee than they do in the CAT. And that enables, a lot more flexibility in whatever construct we come up with here. But if we're able to open that market, that's the next frontier for litigation funding. It's also, I think the next frontier for plaintiffs' lawyers who will have a mechanism should they choose to use it. They don't have to use it. And there's not always going to be a funder-backed, contested applicant for lead. They can still do it the way they want, but they'll have the option to do this. And it can mean a lot with the after-tax dollars, especially in the big cases, but the small ones too. It also opens up the possibility of, since you'll have that formula, paying some portion of Lodestar, something like that, whatever you can do to make the deal that makes the most sense for the class.
Okay, so if this works, do we think we'll have it'll be more or less attractive to participate in a price fixing cartel in the United States if this goes through? For real. Because that's why they do it, right? I mean, that's why price fixing exists. Right? For profit. So if it's harder and it gets policed and the lawyers have the money.
This podcast, which if enough people listen to this podcast, which I think they will, they'll understand that. Well, let's just go to AI really quickly. So just back to that. In the future, AI case origination, we've all seen it with Dare and other folks, but this is something that's...
Dude, you're getting deep. You're naming particular companies. You're talking about the cat. This is jargon heavy. This is for the hardcores. This is going to be a big episode. Trust me. It's a little niche. We might be a little niche, but you've done it. You've hit it all. It's great. That's why you're here. It's right here.
This is what we do.
We have more time to do podcasts now. You only have one job, so it's pretty good, right? And the dogs.
Right. That's it. Yeah. One job and the dogs. Don't forget about my nonprofit where we find lost pets and reunite them with their families.
Is that tunnel recovery?
Two Tunnels Pet Recovery.
See, I did. That was my crack research staff, aka me. Look at your LinkedIn 30 seconds before we got here to find your ILFA email address. So that was good. All right, so Dai, the question that everyone I have to ask, I'm doing it. This is like, where are you going next?
Yeah, so I'm excited to make the announcement. 6:04. I'm really late for a happy hour for the Class Action Money and Ethics Conference at the Harmony Club. So I'm going to head off.
Right.
But Ted, this was a real pleasure, and thank you very much. And I'll have you on my podcast one of these days.
You're the man. Thanks, brother. Bye.
Thank you. Bye.
Today's episode is brought to you by Level 7 NYC. If your firm is spending on marketing without knowing what's actually working, guess what you're paying for? You're paying for guesswork. Level 7's marketing audit identifies exactly where each dollar's going, where the budget's leaking, and most importantly, what to do about it. Level 7 NYC, the official sponsor of all things litigation funding.